Hi, my name is Jeff Vangeter. I wanted to give you a quick diagram of kind of a rudimentary diagram of a reverse mortgage just to help you understand really how they work in a very simplistic way. So if you'll just look at my stick figure house there, and as we look at this, I'm going to basically divide this into two sections. So when you do the reverse mortgage, we're basically going to divide your house into a section that is the principal or the money that you're going to have access to. That'll be this lower portion here. And the second portion will be the interest that's reserved for the lender. They don't get it all right away, but it is kind of reserved for the lender. And so in my example here, I'm going to use a home value of $200,000, and I'm going to use a 72-year-old male. And in that case, using again just the interest assumptions I'm using, this is just an example. So don't hold me to these numbers. This is just to give you the idea how this works. Interest rates change all the time, and the government changes the program, so you need to get a current quote to find out exactly what's available for you. But in this example, I'm showing $143,000 below the line, so all of that is reserved for you. Now, there's a couple of things that need to come out of this section that's reserved for you, and that's the costs of the reverse mortgage. There's several costs involved, appraisals and loan origination fees and FHA insurance fees that comes out. There's quite a few things involved in that. And the other thing is any current debt that you might have. Maybe you have a current mortgage on your property. That would also come out of your portion. All right. Then we would have money that's available for you. And you could take either all of this money that's available, that's whatever's left after the costs and the current debts, or you could take a monthly income, or you could open a line of credit and just take money as you need it or want it. So very straightforward there. And then above the line is reserved for the interest to the lender. And I'm not sure what that's going to be either, because this is a negative amortization loan. The longer you have it, the more the costs are going to be. And so you could see that interest increase over the years. And so the key thing, and I think the biggest misconception that I see from many people, many borrowers and people that don't really understand the reverse mortgage, is they think that somehow you're giving your house to the lender. And that is absolutely not true. This is a very basic approach. So when you think about this, if you were going to pay off this loan, let's say you're going to sell your house, then it would be pretty straightforward. How much interest has the lender earned? How long did you have the debt in place? What were the original costs and the debt, and how much money did you take? So you add all those things up. That's how much would have to be paid off at the time you sell your house. And with a reverse mortgage, it's not due and payable until you move, sell, or die. And that's everybody on title. And of course, everybody on title has to be over 62 in order to get the reverse mortgage. And so I hope this real simple diagram helps you understand how the reverse mortgage works. It really is a simple concept. A lot of misunderstandings out there. If you have any questions, give me a call. My number's at the bottom of the screen there, 916-207-1879. I do reverse mortgages and traditional mortgages in California. So if you're in California or you know somebody in California that would like some help, have them give me a call. Thanks so much for listening.